Good morning, everyone. And hello to my colleagues, Commissioner McDowell and Commissioner Baker. Thank you, everyone, for coming to another in our series of broadband workshops and hearings. I won't repeat today how important broadband is because I think you've all heard us talk about it, and I think we should jump into this very important hearing. It is available, it will be available online, and I apologize in advance for the fact that I'm going to have to participate in it mostly that way. But one of the exciting things I think about where the Commission is today is that by working collaboratively with staff and with other commissioners, we're able to do more than one thing at once. And I think that's very healthy. Commissioner McDowell and I and our staffs and Commissioner Baker have been talking about this particular hearing. There's a hearing on adoption in South Carolina next week. There'll be one on disabilities here in D.C. coming up. I encourage all of you who are new to this to take a look at the, I think at this point, 30 workshops that we've done. We're probably on 4 commission hearings, and we're doing everything we can working together to get as much real participation as possible. I thank all of the participants in the panel for being here today, and those of you who have chosen to be in the audience, I thank too. There are typically for these things a lot more people who are participating online than who are actually in the room, but it's great that you're here, and there'll be a chance over the course of the day to ask questions. On the panel, we'll have today financial investors and analysts, venture capital investors, network operators, people with perspective from wired, wireless, and satellite industries. We all understand at the Commission how critical it is for us to get our policies around broadband capital formation right, to encourage investment. This is one of the central goals of our broadband project. It'll be an important theme in our broadband plan. Without investment from the private sector to build a 21st century network for all Americans, we won't be able to achieve our goals around innovation, competition, economic growth, and job creation. This is something that we need to have a partnership with the private sector. We need to understand what kind of rules we can best have to maximize various kinds of investment, investment by financial investors broadly in the market, investment by network operators in their networks, investment by venture capitalists and others in early stage companies around the edge of the network or in the cloud, investment by equipment makers, investment by other categories of people I'm not mentioning, but who are all part of the ecosystem of what should be a world-leading 21st century communications infrastructure in the United States. Our broadband team is still working on data. Maybe we'll hear some good data today. When the House Committee on Appropriations authorized the stimulus plan with respect to broadband, it said that every dollar invested in broadband leads to a tenfold return in the economy. And one doesn't have to commit to exactly those numbers to understand that the nature of communications technology and communication infrastructure is such that we get incredible returns for the country by making sure that we have a ubiquitous, high-speed, robust Internet infrastructure in our country. From the panelists today, here are some of the questions that I have that I hope the Commission, that I hope the panel will address. What can we do to make the telecom and media sector, wired and wireless broadband in particular, attractive for capital compared to other sectors of the economy? And yes, we would like to one-up other sectors of the economy because we think that's healthy for the country given the nature of communications as a general-purpose technology that will further productivity in so many different areas, from selling cars to providing health care to improving our education. How should we think about the appropriate levels of return on capital invested, given the different risk profiles of investments in the network and on the edge of the network? How do we balance consumer-oriented goals, such as lower prices and increased competition, with investment-oriented goals, such as adequate returns? How should we think about the best deployment of public sector capital to best leverage private sector capital? And in general, what actions can the Commission take to unleash market forces or fix market failures to encourage optimal flows of capital and capture their ensuing benefits for the country? I'd like to note my advisor, Priya Iyer, who is here and will be here. She's here. over there, and I hope we'll have a chance to participate today. Other legal advisors are here. I welcome them all, and I particularly thank my colleagues, Commissioner McDowell, who's worked very hard on thinking through what this panel can be to best tackle some of these issues that I've mentioned. And I know that Commissioner McDowell and Commissioner Baker will have questions as well. And Commissioner Baker, thank you as well. I really appreciate how active you've been in these hearings. I know you've been focusing on spectrum issues and organized a hearing in Austin, Texas that went very well. And we have more to do on that subject and others. So I will turn the mic over to Commissioner McDowell or Commissioner Baker. Either way. Commissioner McDowell has happily volunteered to be the moderator today, and I won't promise that he'll stay all the way through, but he'll make sure that this hearing is successful, and he'll also make sure that everything that is said today not only gets in the record, but is communicated in a vibrant way to all of the people involved in our plan at the staff level and on the commission. So I leave it to the two of you. I thank you, and I know this is going to be a great day.
Thank you, Mr. Chairman, and many thanks to all of you for coming today. And we will try to keep this on schedule as much as possible. So I'm going to keep my opening remarks very brief, and I know Commissioner Baker has some, and we also are honored to have the chair of the D.C. Public Service Commission, Betty Ann Kane, here as well. I know she wants to make some opening remarks as well. So I do want to thank the chairman for helping us set this up, and the good hard work from himself and everyone on his team. And also want to thank Paul Gallant for all of your efforts. You've been very, very helpful. Krista Witnowski, Roger Goldblatt, I see you in the back. You always hate to be pointed out to be thanked, but did want to thank you. I also want to thank in my office Angela Giancarlo, who's worked on some very long hours on this. I'm not going to go into the bios of each of our panelists, but I want to thank all of you very, very much for coming today. You do, as the chairman said, represent a broad range of backgrounds and different points on the chain, the value chain, so to speak, of investment. And so you'll be bringing different perspectives and have different points of view, and that's what we want to flesh out here in a minute. And we'll get to you all here in just a minute. At the outset, I'd like to note that this is about capital formation in the broadband sector, and this isn't the beginning or the end of this discussion. But as I've looked at a lot of the workshops that we've had and a lot of the discussion, there are some wonderful ideas being put forth as we try to put together this broadband plan that Congress has mandated we present to them on February 17th. There's some terrific ideas, but one of the questions that hasn't been asked or answered yet is, how do we pay for all this? So we have to look at the beginning of the process. Basically, you have private sector investment. You can have some public sector investment. Private sector investment alone this year, I've seen estimates upwards of $80 billion. It's been private sector investment for the most part that has built out deployment to perhaps 95 or 96% of the U.S. population, and adoption by maybe up to 2/3 as well. But we can do better. We can do more. And so that is what Congress has asked us to look into. But to paraphrase George Harrison, it's going to take money. And that's where you all come into the discussion. One of the things that we're not addressing specifically today, but will be addressed tomorrow and in the future some more, is access to capital. So certainly the diversity of entrepreneurship in the marketplace is very, very important. And I will be attending the diversity in the context of the Broadband Plan panel tomorrow, and I understand there might be yet another one in the works. So that's very, very important. We're only given an hour and a half today. We invited many panelists. Thank you all for coming. Some panelists couldn't come because of rules within their companies, and we understand that many of you do have other rules that you have to abide by. So if we end up asking you a question that makes you uncomfortable, please disclose your Sarbanes-Oxley disclosures and all the rest, that you don't want to say anything that could be market moving or otherwise breach some sort of rule that you have. So I wanted to get all that out of the way up front. So without really any further ado, I'd like to maybe turn it over to my very distinguished colleague, Meredith Attwell Baker, for some opening remarks, and then the chair of the Public Service Commission, and then we will march down the table here. If I can ask everyone to try to keep your remarks as brief as possible. I want this all to be informal. I would like plenty of time for discussion and questions, and also for each of you to come up with questions for each other or for myself or whomever, and also from the audience as well. And we will do our best to end at noon, but that's only now an hour and 14 minutes away. So the longer I talk, the less you can talk. So, Commissioner Baker.
Well, one of the nice things about being, going last is that all of the eloquent introductory remarks have already been made. So with that, you all have very diverse backgrounds, and I am very anxious to hear from each of you. I have lots of questions. You know what they are, what factors drive investment. The chairman outlined some. Commissioner McDowell outlined some others. What causes you to invest in one industry versus another. And then just kind of some basic ones that are very pertinent to this proceeding. What broadband policies should we avoid? Which policies should we try to do? But you know what we're after, and you're the experts, and I can't wait to hear from you. We're really looking forward to it. I also want to acknowledge Commissioner Mignon-Clyburn, who's in the room, and I think the fact that you got 4 of us here so far shows how important what you do is to what we are trying to do. So thank you for being here. Thank you, Commissioner McDowell, for holding this, and to your staff for working so hard, and to the staff who I know it's hard to put together. Roger, way to go. We really appreciate it.
And Commissioner Clyburn, I apologize. I didn't know you'd come in, so I do want to recognize you. Thank you for coming. And you don't want to say anything. Okay. Okay. And with that, the chair of the D.C. Public Service Commission, Betty Ann Kane.
Thank you very much, Commissioner McDowell and Commissioner Baker, and my former colleague, the State Regulatory Affairs, Commissioner Clyburn. I'm very pleased to be here. I was asked to give welcome remarks. I think most of you probably are ready from Washington, but anyway, welcome to Washington. And I'm also here as one of the state members of the 706 Joint Conference on Advanced Services. And on behalf of Larry Landis, who is the Commissioner from Indiana and Chairman of the 706 Joint Conference, and all of our other state members, I want to thank you for involving us in each of these field hearings. And we look forward to working with the Commission as you go forward with the National Broadband Plan. This field hearing, called a field hearing, although it's in D.C., but I would point out that the D.C. area is not only the nation's capital, but a real place, and we do have the same challenges and concerns in terms of broadband availability and particularly affordability in this area, as well as the deficiencies in the provision of broadband services for police, fire, and public institutions. And also might notice that while the subject of capital formation might at first appear to be a wholly private sector issue, it is instructive to note that state and local governments, as others have mentioned, also play a significant role in the provision of capital resources for broadband infrastructure development and adoption. The District of Columbia, like most other state governments, has a long history, for example, in franchising and regulating the deployment of infrastructure for cable, video, and telecom services, and includes investment of public funds in infrastructure through public and private partnerships and networks. And also, most state utility commissions are well versed in the issues of capital formation by public utilities and things like rate of return, et cetera. And irrespective of whether its public utility engages in the provision of broadband services or another entity, one of the key elements to encouraging private and public investment in broadband infrastructure is the financial viability of the return on investment for such projects. We believe there are a lot of programs in states that have provided a framework of certainty and a mechanism by which it is possible for a private provider to make the construction and operation of broadband services a viable business model. We think one of the best ways to determine whether a proposal to fund or invest in a new or expanded broadband infrastructure project is to look at the successes and shortfalls of similar projects in other areas. And with that in mind, the state members of the 706 Joint Conference undertook to develop a website to collect and share information about broadband best practices. I was tasked with leading that project, and with the financial support of the National Association of Regulatory Utility Commissioners and the technical support of the National Regulatory Research Institute, I'm very pleased to announce that we call it broadbandbestpractices.org, and it's now online. It's up and it's online. We did brief some of the FCC staff on that at our meeting in July. One of our features is an inventory of broadband programs nationwide, particularly that have state and local involvement, and there is a section on each of those about the financing and about how the capital was formed, so we think that will be instructive. And we invite you to look at the website and to put in information about your projects. And thank you again on behalf of the state members. We do look forward to not only gathering the information today, but working with you as we go forward. Thank you.
Thank you so much. I think we will start. We've divvied this up alphabetically, if you hadn't noticed. We have 3 people whose names start with K. Just a little piece of trivia there. I don't know what the odds were of that. But anyway, so you probably, Tom, get to go first a lot because your name starts with A. So if you could start, we'll try to keep your remarks to 5 minutes. If it looks like you're going way over that, I will politely nudge you to maybe wrap it up and then move on.
Wish that had worked on the airplane this morning.
By the way, these mics work better if they're really close to your mouth, I've been told. So.
Okay, thank you. Well, I would echo the introductory comments I've heard. In my words, you got to like broadband. I don't think I need to spend a lot of my time talking about its tremendous potential for creating value for consumers and producers and enhancing democratic values. Broadband has been and will be a great boon for free speech and free enterprise. And I'm delighted to be here to share my perspectives in the context of its past, present, and future. A little past, reliable high-speed technology has certainly been the holy grail for network engineers for decades. Network technology briefly pulled ahead of applications technology in the early 1990s, with potential networks, ISDN and better ones, that were left wanting for workable applications over these faster pipes. The World Wide Web was the killer application that everyone had been waiting for. And the killer app raised the ante for all players involved. Networks improved. Entrepreneurs leapfrogged each other. Fortunes were made and lost. And despite the turmoil, we have a robust, competitive, and innovative communications environment today. As a result of the union of innovative technologies developed by large and small businesses, academics, and government, we have enjoyed a 2-decade renaissance in networks and applications, and it is proceeding apace. I believe the United States is an enviable market for communication services. We are lucky that we have solid, substantial, facilities-based private competitors in each major communication service, including wireline, wireless, and satellite. No country in the world has seen such communications investment driven more by imperatives of competition and markets and less by government mandates and subsidies. We have reason to be proud of the balance in our system that has produced this environment. However, that doesn't mean that we shouldn't aspire to more. For example, geographic expansion, greater priced cost choices, and continuing network, device, and service upgrades for functionality and capacity. These goals should and can be accomplished. At the same time, we should recognize how much we have achieved and be cognizant of what has encouraged or hindered this progress. Over the past 25 years as a student of the communications sector, I have witnessed startling progress to me. Telephone company managements raised on monopoly markets have had to learn to be competitors and respond to markets. Rather than be dependent on depreciation schedules, the sometimes slow pace of conservative engineering, and regulatory gaming. I have seen cable companies develop much more sophisticated marketing and engineering expertise with increased focus on quality of service rather than relying purely on stringing coax and high-wire financing. And whole new sectors and services have been created that rely on communications networks and enhance the network and the Internet experience. This dynamic industry is interrelated and codependent. Maybe that's what makes for such sometimes vociferous arguments. Undeniably, the issues surrounding broadband are very subtle and sophisticated. I don't believe they lend themselves as well to broad political and legislative solutions, but rather to the balanced, deliberative process of which the FCC and FTC and other deliberative bodies are capable. Let me, for a moment, mention what I do. At GE Asset Management, I advise portfolio managers on what investment-grade bonds or other fixed-income securities to buy, sell, or hold. We manage investments primarily for institutional investors, insurance companies, and the GE Pension Fund. We currently have under management about $110 billion. I would note that fixed-income investors often have a very long investment horizon that can run 30 years or more, and they are, in fact, they are obsessed with risk, and I hope to talk about that a little bit more later. A little more background on myself. I began my career here in Washington, working in the House of Representatives. I then worked at the Interstate Commerce Commission as Assistant Legislative Counsel dealing with trucking and railroad deregulation. After legislation was enacted, I was an attorney advisor for two different commissioners and focused on implementing the Staggers Rail Act and the Trucking Act. So while this is a new building since I was in Washington, I think I understand a little bit about the functionings. I subsequently earned an MBA at Columbia Business School, worked at AT&T the summer after divestiture, and was a consultant to venture capital and telecoms. In 1988, Ellie Noem asked me to work with him on telecom issues at the New York Public Service Commission while he was on sabbatical from Columbia. It was a postgraduate education. In 1990, I went to Wall Street and became a fixed-income telephone analyst at Lehman Brothers, later Citigroup, J.P. Morgan Chase, and now GE Asset Management. I have expanded my investment coverage beyond telecom to cable, media, technology, and most recently healthcare and pharma. I think the issues here are a lot more fun than those. Some might suggest I have to be schizophrenic, working as a public servant and regulator on one hand and as a capitalist and market participant on the other. Well, I won't admit to schizophrenia, but I think I can understand both sides of the issues faced by both the regulators and the regulated industries. When I came to Washington fresh out of law school in 1977, I believed that government can and must make things better. I worked with bright, honest, hardworking colleagues who too wanted to make things better. I think we did some of that. But my two regulatory experiences convinced me that less regulation was better regulation. I didn't say no regulation at all. Rather, my personal philosophy is regulatory minimalism. In over 20 years' involvement with telecom, cable, and media sectors, I strongly believe regulatory minimalism is just as appropriate and needed as it was in transportation. In simplest form, the question is phrased, would government action be nice or is it necessary? I would say nice is not enough. I'm hoping that we can, as I mentioned, go into a little more detail about risk and uncertainty because it not only affects investment decision making, but it also affects the operations of the businesses and their costs. And I'll leave it at that. Thank you.
Thank you very much. And I should have introduced who you work for at the beginning. I'm sorry I left that out in your title and employer. So next we'll go to Phil Bronner with Novak Biddle Venture Partners from a different part of the investment timeline here, different stages.
Yeah, exactly. So I think we're on the exact opposite side of the financing spectrum. So I'm with Novak Biddle, as he mentioned. First, thank you all for having me. Very excited to have this conversation. I agree. I think broadband can have dramatic impact on our economy, and I'm very interested to hear some of the thoughts from my other panelists. Very briefly on Novak Biddle, and then I'll really look to try to address the question of, how do we pay for this? Novak Biddle is a $600 million venture fund. We're based in Bethesda, Maryland. We focus on IT broadly, so we'll do anything from a semiconductor deal through enterprise infrastructure, as well as broadband-related investments and internet investments. I've been with the firm for about 10 years now, and I focus on the internet sector, broadband, and software. So how do we pay for the broadband rollout? Really to frame my thoughts, let me give you guys a sense of where I come in. We bet on innovation. So we come in early when you think about investments in broadband. We have to see kind of a fundamental shift in the infrastructure for us to make the investment. And we're taking technology risk as well as market risk as well as financing risk. And when you look at what's happened over the last 5 to 10 years, there has been innovation as it relates to wireless. And so, we made a bet around WiMAX a few years back. And so what you see there is that the cost associated with rolling out WiMAX infrastructure relative to others is dramatically lower. And so that's a very positive when you think about rolling out infrastructure across the country. The issue you have is that the ROI has to be there at each point in the value chain. So we come in early. We bet on the technology. We have to prove that it works in we call it nature, but in a small environment. We then have to pitch to later stage investors to convince them that it makes sense for them to invest to roll this out. And when they come in to take a look at it, they look at the economics of the deal that we put together, but also they have to look at the split between the equity that they put in and the debt that somebody else puts in. And when you look at what's happened recently, the debt markets, the cost of capital is quite frankly too high to roll a lot of these things out. And I'm sure some of my other panelists will talk to this. And so when you look at rolling broadband infrastructure out, you really have to look at solving the debt problem. And I think there are two ways that's happening right now, one of which is on the vendor side. So I think there are equipment providers who do want to get into these next-gen networks, and I think they are looking to step up and provide financing. In addition, I think the government made a nice strategic move around the stimulus plan to really put dollars into the mix to couple those dollars with debt dollars from other players and equity dollars from other players to finance these rollouts. So when I think about the problem of rolling out broadband, that's the way I frame the problem. And I'll save the rest of my comments to questions.
Thank you. So next we have Chris King with Stifel Nicholas.
Good morning, and I would like to thank the Commission as well as all the commissioners that are here for the opportunity to speak this morning. Just to give you a quick background of what I do, I'm a sell-side equity analyst at Stifel Nicholas, which is a Baltimore-based investment firm covering the service providers, so the telecom, cable, wireless service providers, the bells, the smaller rural carriers that cover the country. Wanted to couch everything that I say. I am going to be coming from more of a service provider's standpoint here in my discussion. First, before we talk about where we want to go as a nation with respect to broadband and capital formation, first wanted to take a half step back and talk about where we are today. And quite frankly, as an equity analyst covering the telecom/cable sectors, not in a great place right now from a capital market standpoint. Highlighted there, 4 of the top 5 highest dividend yields in the S&P 500 index are telecom service providers, and I've listed the 4 of them there. All 4 are RLECs. I think you can consider Quest both a Bell and a rural carrier at this point. Point being there is particularly with companies that are paying out such a high percentage of their free cash flow to common shareholders, those dividend yields reflect the cost of equity that these companies have. And certainly, at least according to the equity markets right now, this industry is at the high end, certainly among the S&P 500, for their cost of equity in the current market structure. AT&T and Verizon have never traded at such historic yield spreads over U.S. Treasuries. Both AT&T and Verizon have close to a 6.5% dividend yields. Comcast and Time Warner Cable on the cable side are trading at historically low valuation multiples, certainly as it relates to EBITDA or operating cash flow. Just a quick graph here. This takes a look at the valuations for several subsectors within the telecom world over the course of the last 5 years or so. The top line there is the high-yielding ILEC index, which is essentially consists of a lot of the RLECs. The rest are various groupings, including the yellow line there, which reflects the bells. As you can see, valuations have been under consistent pressure across the telecom industry over the course of the last 4 to 5 years. Real quickly on this slide, just wanted to take a quick look at some of the significant mergers and acquisitions activities that have taken place over the last several years. And on this slide, what you see, 2 real lessons here. The first lesson is that all of these acquisitions have really taken place in a relatively difficult capital markets environment for everyone, really over the course of the last 2 to 3 years. One lesson to take away from this, certainly in our view, is that telecom is a scale game. So the larger providers do have significant inherent advantages that are very difficult for smaller carriers to overcome. and that's just whether we want to call that a kind of a natural monopoly phenomenon or not. That is the way that a lot of equity investors certainly look at the telecom industry. Secondly, cost synergy achievement is increasingly important to management teams, particularly in the RLEC world. One of the only ways I think that management feels that they can create value for shareholders in today's telecom environment is achieving synergies through mergers and acquisitions. Certainly the majority of those are cost synergies, be that headcount reductions in capital expenditures. Certainly the benefits of having greater scale also come into play there. So in my humble view, what is needed, particularly from a regulatory standpoint, certainly the capital markets like long-term regulatory certainty. I think at the end of the day, that is what investors look for above all else. They just want to know the rules. They don't want the rules to be changed. They just want to know what the plan is from a regulatory standpoint going forward, as do certainly most of the companies that I cover. Certainly one example of this is the net neutrality discussions that are taking place right now, and I certainly do not want to add to the what I'm sure will be a very healthy record you guys will have to look at on that issue, but that does inject some amount of uncertainty, which certainly will not help cost of capital, certainly until that issue is resolved. Secondly, certainly from the carrier standpoint, they would like to see a comprehensive broadband support structure needed, whether that is capital commitment support in the form of grants or tax credits. As I mentioned here, certainly some of the larger telcos and cable MSOs that do cover over 90% of the country have publicly complained regarding a lot of the reporting requirements and restrictions associated with the current broadband stimulus program, have chosen not to participate, at least in the initial rounds of that stimulus program. As a result, at least that's what they tell investors. Operational expense support, some of the RLECs have focused on this in particular, related to the high cost of special access or middle mile access that largely the bells have been charging in the rural areas. So they would be supportive certainly of tax credits to offset their own middle mile investment or potential re-regulation of special access in rural areas. From an analyst perspective, one of the things that I wanted to touch on to wrap up here is incentives for broadband usage in general. From a purely numbers perspective, the bigger problem is still penetration rather than availability. Again, depending on how you want to define broadband plant does cover over 90%, or roughly 90% of all citizens of the U.S. Today, yet we still have 55-60% penetration of broadband in terms of customers signing up for the service, whether that's a cost issue or an availability issue or a quality of service issue. I think those are all questions that need to be addressed, certainly. But at the end of the day, a lot of those do seemingly point to some type of universal service support mechanism for broadband in our view. So that is something I think that should be considered longer term as we look to a broader broadband program in the U.S. And with that, thank you very much.
Thank you. And I'd like to go out of my way, by the way, to thank Anna Maria Kovacs as well for helping put together this panel and all of your suggestions. So Regulatory Source Associates, take it away.
Thank you very much, Commissioner. And let me just get my disclosures out of the way for my own regulation. Neither my firm nor I engage in investment banking. We don't trade stocks. I don't own stocks. And I do believe what I say here, and that is not affecting my compensation in any way. Anyone who wants to see it in writing, it is available in the back of the room. And having gotten that out of the way, I think what I'd like to focus on is a little bit maybe more nuts and bolts. What is it that how it is that investors really look at stocks and bonds as they make their investment decisions. And it really boils down to a couple of things. How much money is involved? So in the context of broadband, it's how much capital is required. And then return really comes down to revenues and expenses. Anything that increases revenues, decreases costs, obviously is a positive, and then you measure risk with rate in terms of rate of return or yield or whatever. When Chris talks about the yields on the phone stocks being the highest they've been, he's saying that investors are seeing this as the highest risk environment that they've seen. So one of the things that I think is important to look at when we talk, as the chairman did, about the ecosystem, the application side and the network side. The two are obviously both essential. They're iterative. There's no point in having a network if you're not going to have applications. There's no point in having applications if there's no network to run over them. We tend to focus in talking about broadband cost and capital because that is the capital-intensive piece of this ecosystem. That's where most of the money has to be raised, and that is where most of the risk is in terms of the capital being tied down. Once you have spent it, it's in the ground. You can't take it anywhere else for the most part. And it is important when you start looking at that to disaggregate a little bit further within the context of broadband. Chris did a little bit of this in terms of looking at urban versus rural. When we talk about whether, quote, a broadband problem in this country, for the most part, that problem is in the rural areas because that's where most of the capital is needed. One of the things that I find disturbing is that very often people talk about consumer interests and investor interests as being either totally different or even in conflict with each other. And I think particularly and in some cases, perhaps in some industries that may be true, but when you're looking at broadband deployment, I think it's important to recognize that the two are very much aligned in the sense that if you cannot raise the capital and raise the revenue to justify that capital and to pay for the expenses of providing the network, then you are not going to be able to provide the services that people want. So when people are looking at, are you getting a high enough return on the one hand, and what is happening to pricing on the other hand, and how many services can the broadband providers use as sources of revenue? Can you make money on content? Can you make money on service quality? Can you make money on business as well as residential? All of those sources of revenue effectively support a single network and a particularly high-cost network in rural areas. And it is in the mutual interest, I think, of both sides to make sure that, yes, on the one hand, consumers are getting reasonable pricing for very good services, but at the same time recognizing that unless the companies get and the investors, ultimate investors in the companies, get their returns, that network won't be there, it won't be upgraded, it won't be maintained, and we'll have, the broadband equivalent of the potholed streets that my town of Cambridge is full of. Let me let you take it.
So we did not invite the mayor of Cambridge here today, apparently. So perhaps that's for a different.
We're still waiting for the stimulus money to fix our roads in Cambridge. So.
I'll stay out of that one. So. In any case, we have Monish Kundra from Columbia Capital, also at the early stages of finding new companies.
Sure. Thank you, Commissioner. And I want to thank the Commission for the chance to be here to talk a little bit about Columbia, as well as to comment on some very important topics. So just by way of background first, at Columbia Capital, we do focus on service provider businesses. I think some of the previous panelists actually provided a good segue for me to explain where we fit. We kind of fit in between where Phil and Tom are. We don't invest super early stage nor in technology. And once it's public, it's sort of, we may have an ownership interest, but that's the tail end of our investment typically. So we're kind of right in the meat of it. We evaluate opportunities from the standpoint of can they be continuing can the services and the amount that we can charge for a deployment of infrastructure justify the amount of capital that's being deployed for the launch of a specific network. But more about that later. Just a little bit more by way of background. I have experience around capital raising on the debt side on Wall Street. I've also been on the company side on a number of occasions. I've seen good regulation, or let me put it this way, I've seen regulation work in a way that has allowed us to be successful. For example, I most recently ran corporate development for MSV Skyterra. I think through positive regulatory modifications and the FCC support, we were able to free up a very important piece of spectrum for the deployment of potential broadband services. So as you'll hear in some of my other comments, I think the Commission has played and can continue to play a very useful role. I've also seen, as a CFO of a VPN services DSL business that was trying to take advantage of the 96 Act and unbundling, the challenges of deregulation when it comes to really changing the psyche of a monopoly or an incumbent, and we had lots of challenges when it came to that. So I think the purpose and the objectives were very positive and clear, but the actual implementation was much more complicated. So while the policy was intended to be great, the implementation just proved to be a little bit more complicated. So I am a big believer. I think Chairman had put out a multiplier of 10 in terms of every dollar that you spend on broadband has a tenfold increase in applications and other values. I don't know if that's the multiplier, but I can tell you I think we're big believers in the fact that a multiplier does exist, or we wouldn't be doing what we're doing. If there's one comment I'd like to make by way of this broad issue, it's how do you frame the issue? Because it's a big issue by way of providing broadband broadly across the country. And I think it's really important on the front end to define success and to define objectives. And so let me go through two or three thoughts and categories of success and objectives and then I'll pepper in some investor perspectives into each of those. I think where quite a bit of attention has been paid is in the unserved area, as my previous panelists have described. And I think that issue has been framed to the 3 to 6 million or so folks in the country that don't have any broadband access. And I think you could subdivide that issue even further to say part of policy could be to allow at least a single point of access to those individuals to broadband pipes to the Internet. The other issue is the continuing operation of those broadband pipes. And so from a perspective on the investor side, the first thing I'll say is when we evaluated the stimulus package and looked at some of the unserved markets where we found significant challenges, where you could facilitate, policy and stimulus money could facilitate the initial construction of the networks, but even the operation and ongoing cost of operating these networks made it very difficult to actually keep the networks up and running. So what can the government do? And I thought the information that came out yesterday was very telling. I think the chairman in his remarks described, on the one end, if you want to provide everybody a base level service at 768 kilobits per second, the cost is roughly $20 billion. If you want to provide everyone a service of 100 megabits, the cost is, I think, another stimulus package or $350 billion. So I think framing what we need to do is really important, but just as important as framing what we need to do in protecting taxpayer dollars, it's creative solutions to issues of deployment. If what we're trying to do is provide a basic level of service to the unserved, there's other creative ways to do it. For example, other nations have created structures by way of reverse auctions. I don't typically point out Chile, but Chile it's an example of their cause was to deploy into rural markets, so they utilized a natural resource on their spectrum at 2.5 spectrum to say, we'll provide a subsidy, we'll provide you spectrum, now bid for how much of the subsidy you need. That's, in my opinion, one way of being regulatorily minimalistic, as I heard previous panelists say, but really I like the idea in my thought process of what's the least the government has to do to make it interesting enough for somebody else to deploy, and we look at situations like that. So the unserved area, I think, I'm sure we'll talk more about that in the Q&A portion of the panel. I think there's another issue that could be tackled, which I think there's a lot of press about, the average speed for everyone. The Commission could bite off, or stimulus could bite off, increasing the average speed for everyone. I think from a minimalistic standpoint, that would be a big challenge, but I think policy-wise, this is where policy could come in to free up additional spectrum, for example, so that that idea of increasing speeds is something that could be in the hands of the folks that are actually out there in the market. No better way of knowing whether the demand warrants the construction of additional networks, but then to provide a facilitation by way of resources like spectrum to be able to launch those networks. And the last comment that I'd make is, when we think as investors, we also think about future-proofing. So whether we're talking about unserved or we're talking about networks that could be enhanced for greater broadband, we also have our eye on 4G. We've seen innovation by way of the iPhone. We've seen innovation by way of the creation of applications which greatly improve efficiency. We'd very much like to put something in place, if we're putting something in place, that not only can provide a broadband solution to the consumer or business at their place of home or their place of work, but could segue into a network which has applications for the future of mobile applications. So I think these are a lot of big issues. I think I'm pleased that the Commission has taken on these issues, and I enjoy and look forward to the continuing debate.
Thank you so much. That was very helpful. So next is Dean Manson with Hughes Network Systems.
Thank you, Commissioner McDowell, Commissioner Baker. Thank you for this opportunity on behalf of Hughes to participate in this important discussion and to share with you some perspectives on how government policies can impact capital formation by broadband providers. Hughes is the world's leading provider of broadband satellite networks and services, including high-speed access to approximately 500,000 households in the United States. The vast majority of these households are located in areas that are not served by other broadband technologies, such as cable, fiber, or DSL, primarily because the population density in those areas is not sufficient for such technologies to be economically viable. The HughesNet service is available today to anyone, anywhere, and we offer a number of affordable service plan options based on customers' needs. Throughout the years, we have worked closely with the FCC in attempting to bring broadband access to all Americans, recognizing that truly national broadband coverage cannot exist without satellite systems. A significant portion of the more than 10 million unserved households in the country will never be economically or practically served by terrestrial wired or wireless broadband networks. As noted at Tuesday's Open Commission meeting, expanding broadband usage throughout the United States via wireless and landline infrastructure would cost as much as $350 billion. At that same meeting, it was estimated that the capital cost of providing wireline service in rural areas is more than 8 times that of urban areas, and the transport cost is more than 25 times that of urban areas, or approximately 25 times that of urban areas. By contrast, with a cost structure that is virtually unchanged regardless of geographic area or population density, clearly satellite has an important role to play. Over the past 3.5 years, Hughes has been successful in raising significant capital to fund the rapid expansion of our broadband satellite service, over $100 million of equity and $700 million of debt. In each case, our investors or lenders evaluated 2 key factors. First, the proven strength of our business, and second, the relative stability and predictability of the environment in which we operate. Capital markets thrive on stability, and government policy should not prejudice or jeopardize access to capital in the broadband marketplace by introducing unnecessary uncertainty and instability. In the satellite industry, the ability to predict the future is perhaps even more important than in some other sectors where build-out occurs more incrementally. The infrastructure cost of a broadband satellite is incurred primarily up front before any customers are connected. A new broadband satellite costs in the neighborhood of $400 million to build, launch, and insure, and much of that expense is incurred 2 to 3 years before the satellite is even launched. This means committing to purchase a new satellite, an operator must be able to see many years down the road and predict not only the marketplace and competitive landscape, but also the regulatory environment into which the new satellite will be launched and operated. Indeed, the regulatory environment maintained by the FCC is one of the most critical components our investors and company management consider in evaluating new capital investment. For example, crucial to a stable regulatory environment is assurance that the radio frequency spectrum that the satellite will use for its Earth-to-space and space-to-Earth transmissions is available for the 15 to 20-year lifetime of the satellite and is free from the prospect that other satellite systems or other services will cause harmful interference. As it considers efforts to provide the right amount of spectrum for wireless broadband services and to maximize the efficiency with which all radio services employ the spectrum allocated for their use, we believe the FCC should remain mindful that revisiting well-established spectrum allocations can cause disruptive perturbations in the markets and provide the markets that provide capital financing for satellite projects. Similarly, when the government incentivizes more rapid adoption of broadband through such programs as the broadband stimulus, we believe it should strive to implement those programs in a way that enhances rather than distorts existing well-functioning markets. To suggest a specific example, in the next round of stimulus funding, the government could adopt an approach that enables consumers themselves to select the technology and provider that they prefer. The government could, for example, establish a fixed subsidy amount available to any provider of any qualifying technology who acquires a new customer in a targeted area, such as an unserved or underserved area. Similar to the recent Cash for Clunkers program, this would leave the choice of provider to the customer. Imagine how distasteful Cash for Clunkers would have been for consumers and car dealers alike if instead the government had said, in this county only Fords qualify and only from this particular dealer. And in that county it's only Toyotas from another specified dealer. Not exactly consistent with the well-functioning free market and the positive forces of supply, demand, and consumer choice that are the bedrock of our American economy. The alternative of a fixed subsidy along the lines I described would also have the benefit of subsidizing only the actual acquisition of a new subscriber and would eliminate the risk that taxpayers could end up funding the broadband equivalent of a bridge to nowhere. In conclusion, I come back to the core message. In creating the broadband plan, the FCC can encourage capital investment by minimizing the uncertainty and instability that could be introduced by dramatic changes to the fundamental principles underlying our regulatory environment. To have the most positive impact, the government would work with rather than against the principles of competitive markets and consumer choice that make our economy so great. Thank you.
Fantastic. Thank you. So last but not least, we have Luke Simsack with J.P. Morgan Asset Management. Thanks for coming.
Thank you, Commissioner. Good morning. My role is as an analyst. I cover both the telecom services and cable as well as the equipment industries that supply the equipment for making our phone networks and cable networks work. I thought it might be useful to start by just discussing how investors like myself evaluate new business opportunities. My perspective is as an investor in public equities. And often I have a situation where a company announces that they're going to enter a new business market, a new market segment, or maybe they're going to enhance their existing infrastructure to provide new services to their customers. And I think the process that one goes about to evaluate that is similar to what we heard earlier in terms of in the venture capital industry. Similar tools. Maybe we have slightly different amounts of information, and I just wanted to step through the major things we do, which is data collection, analysis, and then evaluation of the investment. And firstly, in the data collection phase, I think some of the key things that one would focus on is defining the market opportunity, understanding who the customer is, what kind of services that customer would buy, what substitutes exist for that service, how much would have to be built and how much would have to be invested to tackle the opportunity. What are the exogenous variables, such as the level of government regulation or change in regulation, etc.? I think there's more, but this sort of gives you a sense of some of the key things we might consider. Next comes the analysis. And in this phase, we really want to evaluate the opportunity so that we can go and measure it against other potential opportunities. So how large is the market is probably the first key question. Is the market growing? How difficult would it be to go in and take share if it's an existing market? Or if it's a new market opportunity, how rapidly can we build penetration? I think the second thing is to think about is how large will the investment have to be relative to the size of the market opportunity? How much incremental investment would be required? We heard Mr. Manson talk about the large upfront cost of a satellite. There might be some other alternative that has a low upfront cost, but maybe it has higher operating costs later. So there are a lot of trade-offs that we have to evaluate in terms of the amount of investment. What are the recurring operating? The third element would be the recurring operating expenses and how much one can bring those down in the future. What expenses are variable, what are fixed? What's used to attract a customer versus how much does it cost to service the customer once we have that customer? Do we have any liability to past customers? All of that is important. The fourth thing is the risk. How much risk is in the business? How volatile is pricing? Is pricing predictable? Do prices change a lot, or is there some control? How easy is it for new entrants to come in and affect pricing? What is the rate of technological innovation, and how can that change both the value of the investment we've made in the past sometime down the road, and how can it change the rate of competition in the industry? And then finally, the fifth thing we would look at, of course, is what's the long-term opportunity? Is there a potential that we could get a big positive surprise in terms of how well this investment performs? Or are there big negative surprises that could occur along the way? And what kind of things might we be ignoring but we probably should be considering? And how big a risk are these factors that we're not considering? So finally, hopefully we have done a good job in our analysis and we get to the final phase, which is really evaluation of the investment against other opportunities. And this is really the most important phase, but it's only as valuable as everything that came before it. And you have to remember there's always the choice after all of this that we don't have to invest. We could just not do anything. So making the investment is not a forced thing. So ultimately, the most important part of this is free cash flow. How much cash will this investment generate? And will that free cash flow cover the cost of the capital that we had to put in to address that opportunity? Now, as discussed already, the cost of capital varies with the level of risk. So the greater the risk, the higher the cost of capital. And the more the risk can be reduced, the lower that is. And that risk is both the risk of competition and regulatory change. The list of risks are significant, but you have to evaluate all of that. Other questions that one might consider is how long will it take for this investment to pay back? Some investments have paybacks of less than a year. Many companies make those investments very quickly. But if an investment has a 2, 3, 5, 10-year payback, you really have to do a lot more analysis to make sure that that investment is a viable investment and that you've considered the many long-term risks. The further out the payback, the more long-term risks that become very key to the investment. I think another key element of all of this is doing some upside and downside analysis of really what are the big surprises that could come on the positive and the negative. For instance, if things go awry in our business model, how much will it cost us to keep going, and will that be viable, and how bad does the situation, if the situation were to get very disappointing on the revenue front, would this entity be viable, or would it end up being not viable at all? So I think I've talked a lot about numbers and things like that. I think the key to remember is that within all the numbers, the numbers really represent a range of scenarios. So even though numbers are used to evaluate the investment, the numbers aren't driving the decision. It's a large number of qualitative factors that we try and analyze via numbers. The process is never exact, and obviously because sometimes businesses fail, it's not always accurate. But the point is to do as good an evaluation and understand all the moving parts to the degree that one can, and hopefully the investment will be considered properly, and if we go forward, it would work. But I think, let me just close by saying that in the end, after all of this analysis, if the numbers do not work, you still can choose not to make that investment. So I hope that at least gives some basis for our discussion today on the capital side of the broadband question. Thank you.
Thank you all very much. You know, when I was first envisioning this workshop or hearing, or whatever we're calling it today, I was hoping that we could get some folks in the very early stages who are identifying brand new companies that might just be an idea somewhere, folks in the middle stage, folks at the post-IPO stage as well, and some objective analysts, and that's exactly what we found. So I'm very, very happy with the diversity on this panel. I have many, many questions. I know we're quickly running out of time. I know Commissioner Baker has questions. You probably have questions and things you also want to continue to say, and perhaps the audience has some questions as well. So we're going to move as quickly as we can. When we get to 12 o'clock, I imagine we won't be done. But if folks need to leave, please let me know, and we'll try to be mindful of everyone's precious resource known as time. So I've heard many things today, and part of, as they say, the old cliche, where you stand, it depends on where you sit. And so that's why it's terrific to have this diversity here. I've sensed from all of you that change can create uncertainty, and uncertainty is an issue. That's something that can keep capital on the sidelines. So I'd like to sort of explore that a little bit more in terms of what changes appeal to your hopes and what changes appeal to your fears. What should we do or not do with as much specificity as you can give me. Sometimes change for entrepreneurs, a regulatory change can be seen as what I'll call a regulatory arbitrage opportunity, but that also has its risks in that if the government is formulating a rule that maybe takes some value from one player to shift to another player, that same government can change that rule, a few months or years later. So that can be unsettling for you just as much as maybe leaving in place bad rules or rules that might inhibit investment. So anyway, let's focus on what are sort of your hopes and fears in terms of what we may do with broadband. What specifically what specific policy should we avoid or should we try to implement here at the FCC? I mean, some of you touched on some, like reverse auctions and things of that nature, but and maybe we can just go back in the same order or in the order of whoever wants to volunteer. And we'll try to keep it as quick as you can. Reverse order? Okay.
Well, I think we heard a lot of great ideas here already. I think the key thing is to have some level of confidence that these are long-lived investments. So it's not a question in many cases of a 2-year payback, but a 10 and 20-year payback. And so when the investments are made, that there's some confidence that things won't change after 3 years once those investments are changed. So some regulatory certainty, I think, is very key. So
whatever we do it and don't change it for several more years. Okay. Mr. Manson.
I would point to spectrum. As I mentioned in my earlier remarks, that's obviously very critical to all wireless technologies, including satellite. And with the long life of a satellite, it's even more critical that we have certainty as to the availability of the allocated spectrum over the life of the satellite. It's a very long-term planning horizon. So we would urge extreme caution in looking at any kind of reallocation of spectrum that could potentially affect satellite companies. And then secondly, I would point to programs like the stimulus, where we would be hopeful that the government, as I mentioned, would work with existing markets and avoid approaches that effectively put the government in the business of selecting winners and losers, but instead put programs in place that allow the marketplace to continue to embody the kind of competition that makes it so robust.
So, can you hear me? So with regard to change, and actually I'll touch on spectrum policy really quickly as well, I think that so consistency of policy I think is really important from our perspective when it comes to making an investment. So as an example, if we were to deploy a network that was predicated on wireless broadband and required spectrum, chances are if that network started to fill up, we would hope that spectrum policy in terms of freeing up additional spectrum was something that continued to exist at the Commission, because more spectrum, as you're successful, you need more, you need to scale more. So I think tone and specific spectrum policy is important. The other thing is I would maybe provide an example to what Luke said. When we make an investment that may be somewhat predicated on a policy, for example, subsidizing broadband or continuing tax credits for folks on an ongoing basis, we're making the determination that that's going to exist for a long period of time. Usually, if there's a sunset to a provision, it's much better to know all those things on the front end. It's really hard to make that investment if you think that there's a significant potential for a change in policy down the road. So that kind of certainty is really important for investors.
I go back to a more general look at this, and then I'll give you a couple of specifics. But in general, if you take Luke's list of the factors he looks at, they feed into the four things that I talked about. How much capital do you need here? Where are you going to get the revenues to support it? What are you doing to expenses? What's the cost of capital? If you look, for example, at an issue like net neutrality, there are all sorts of philosophical questions. But to me, it really translates down to when you talk about reasonable network management, for example, one way to look at that is simply the more congestion you have, the more capital you need to deploy in order to deploy more capacity, and the higher your expenses get. So it's a matter of balancing the costs that are going to be involved here with whatever benefit might accrue from the philosophy. But don't forget that there is a cost of capital itself, risk in the form of a higher cost of capital and expense that's involved there. On the positive side, when you look at adoption policies, to me that translates to increased revenue. There are all sorts of reasons to want adoption of broadband, to have a lot of and adoption of applications that go along with that. But effectively, in the equation that an analyst runs, that comes down to here are greater revenue sources, both for the network and for the providers of the application. So the point I would make is, as you think about regulation, there are all sorts of philosophical issues to think about, but also think about that very simple income statement and balance sheet. What is this going to do to revenues? What is this going to do to ongoing expenses? How much more capital or less capital is going to be needed? And are you increasing or decreasing the interest rate, basically, which is what cost of capital is?
I would certainly agree with everyone's assessment here as an impartial observer, certainly related to the importance of certainty and having set guidelines that don't change every other day regarding longer-term regulatory policies. Just to touch on kind of two topics here, certainly from the companies that I cover, from their perspective and from the perspective of the investors that invest in those companies. Certainly when you look at the telecom sector or the cable sector, one of the things that scares them to death is net neutrality, certainly, and that to the extent that could stifle investment down the road. You do look at companies like Verizon and AT&T that are the single two largest capital investors in the country today. Any regulation that would limit severely their ability to control their own networks or to manage traffic on their own networks. I think that could certainly have a negative role in their levels of investment going forward, as well as wireless and extending net neutrality to wireless networks, having just come off a very successful 700 megahertz auction. I know that certainly my companies would point to that as kind of a bait and switch type of regulatory environment for them. Second thing, just real quickly, because it's already been brought up on reverse auctions, and certainly being technology agnostic is certainly very important in our view with respect to any regulatory structure. We'll just point out, though, with reverse auctions, I think it is important to have the same level of requirements across the board for all of the carriers that are willing to participate in reverse auctions, be that a certain speed level for broadband, be that 5 nines of reliability, be it carrier of last resort for voice requirements. I think if you are looking at something like reverse auctions, the playing field needs to be exactly level for all of the carriers involved.
So, not to sound like a broken record, but certainty is critical. But just to give you the perspective of the venture capitalist, we'll invest in a company, and we may not bear fruit from that company for 7 or 8 years. And so, understanding that the regulatory environment that we're investing in isn't going to go through, significant changes is very important for us for that reason. I think, we're on in addition to investing in service providers, we also invest in companies that create applications that ride on top of these networks. And so the net neutrality side, we're actually probably on the other end of the spectrum from some of the larger players, because when you think about the 10x we're talking about in terms of the broadband payback, a lot comes from the innovation that comes from these applications that run on top. And having a level open playing field there and letting 1,000 flowers bloom is critical for that. And so, when you think of things like distance learning, online education, when you think of a lot of the other innovations that are out there, having a level playing field is critical. So net neutrality is very important for that sort of thing.
Everyone's talking about uncertainty, and I can remember being at a conference, and my former employer, Professor Ellie Noem, got up and said, "I'm tired of investors whining about uncertainty. Markets are uncertain, so just stop." But I think Ellie wasn't distinguishing between controlled risk and random risk. And the difference is that random risk has both unknowable future consequences, and it's uninsurable. You don't know if you're going to die tomorrow or 30 years from now, but you can insure for that. There isn't any regulatory insurance. When I was at Citi a long time ago, I actually tried to develop a product that could insure against regulatory risk. But it's ultimately unknowable because it's so broad and it can be so quick. There are implications for businesses as well as investors. It certainly raises the risk premium, but for a company it means that they can't predict their revenues and cash flows as well in near or long term, and that means the rational response is to create a surplus, and that surplus will tide them over through those periods of uncertainty. That surplus is necessary for R&D, for rainy days, for that cash flow volatility. But another pernicious effect of it is that it makes you raise your prices to create the surplus. So the uncertainty that can be created in a regulatory environment can have the perverse effect of actually raising prices to all users. I want to part of the intellectual exercise here, and it partly is because I'm a fixed income investor, is to imagine the worst. So as I was preparing for this, I was considering worst case scenarios, and there's some awful ones. I actually don't think they're going to happen. I think, fortunately, our system does end up being pretty balanced, and it gets skewed one way or another, and there's cycles. But bad regulation eventually is corrected. Good regulation eventually becomes stale and inapplicable to the market. But in deliberative bodies like this one, those issues can be talked through and resolved, hopefully, with a civil dialogue. So on my wish list are that large, rapid swings are bad, Gradual corrections are good. Clear goals are good. Correcting clear and recurring problems is a good thing for a regulator to do. I'd rather have the regulator err on the side of incenting and encouraging rather than commanding and control. The minimalism is primarily related to the unintended consequences. It is just remarkable, especially as the systems become more complex, how unintended consequences can ripple through a whole ecosystem, as we've been talking about. A little more specifically, is some of the more extreme discussions about net neutrality make me become concerned about inhibitions on new services. Boy, do I want a lot of 1,000 flowers to bloom, or 60,000 new wireless apps to bloom. A wonderful thing for network demand, building networks and borrowing for them at reasonable, stable rates. But if rules intentionally or unintentionally decide to skew the balance toward one side or another, then one side may be prevented from deploying services, and the ones that I'm particularly interested in for the future revenues and CapEx involve contextual advertising, location-based advertising and marketing. There is a whole realm of services that marketers desperately want and smart networks can provide, and sometimes I become concerned that the prospects for those services may be disrupted. And I'm going to just add one other thing, which is wireless, I think, has been quite a remarkable story because it's been lightly or little regulated. And boy, has it blossomed. Now, it hasn't been steady progress. It hasn't even been all that predictable. Who would have thought that a closed system like Apple would open up a somewhat closed system like the wireless networks? And I know innovators who are trying to launch new services get very frustrated that the network has a lot of rules to it, but part of it is because of the complexity of the networks. So that would be a great test bed, I think, to leave in the experimentation mode rather than trying to impose a lot of new rules on it that may have unintended consequences.
Terrific. I think I want to ask sort of one more general question in wireless. Wireless has come up a little bit, and maybe for Mr. Kundra and anyone else who wants to respond. So in that, of course, I've been here at the Commission now for about 3.5 years. Everyone always wants more spectrum. Actually, no one has ever come into my office to turn in their spectrum, really, that I can think of. That's terrific. We're all looking for new spectrum, and I know that's a big interest of Commissioner Baker's, who used to manage the government's use of the spectrum over at NTIA. But once we bring it to market, should this be licensed or unlicensed? Should it be encumbered or not encumbered? And I know, Mr. Kundra, you also talked about there's policy and there's the implementation of policy. So I would like for folks to maybe also comment a little bit on, during that implementation, there's always that litigation risk and the uncertainty, the years of uncertainty that can bring. And when we talk about things such as net neutrality, that's got to be part of it as well. And also I'd love to hear from Mr. Bronner a little bit about any of the companies he's invested in. Have they had difficulty bringing their apps to market? Is there any sort of palpable harm there? But in any case, if we could do that fairly quickly, because I know Commissioner Baker's got some questions, and then we also want to have more discussion among you all.
Appreciate that. So let me address both of those questions from a licensed and unlicensed perspective. And I guess my disclaimer is, now this is maybe more personally my view, I think largely shared by my firm, but I can't necessarily say it's everyone's view. But I believe there's a home for both licensed and unlicensed. I think that for specific applications where quality, insured quality is required, and you need a certainty at the end user level, there's no alternative to having licensed spectrum that you can count on. When you start talking about life emergency type services, when you start talking about public safety, they're just not as conducive to the unlicensed portions of the network they're not quite as conducive to having open networks which are subject to congestion in a way that a single carrier can't control that congestion. I think there's a broad need for unlicensed networks as well. I think that when you look at Wi-Fi applications and hotspot applications at a local level, I don't think that Intel could have predicted how successful the 802.11 standard would have been when it put it on its chip. And I don't think I know a single consumer home, at least in my area, that doesn't have some sort of a Wi-Fi type service. And I think bringing on more of those types of services, for example, white spaces, which I know the Commission has looked at in some great detail, there's a need for that as well. I think that the crossover point is where it gets a little tricky sometimes, in that, the licensed, unlicensed, or the ability to put specific rules around unlicensed spectrum so that it's more cohesive. We want a great highway system, but we also sometimes need traffic lights. So those are, I think, and I'd be happy to get more specific on any of those pieces of spectrum. We have some ideas on how to administer them, but I do think there is room for both.
Yeah, so it's an interesting question around applications. I have an investment in a company that creates games on the iPhone and have been pretty active in looking at new deals in that space. And on one side, they've done a tremendous job creating the platform and allowing 60, 100,000 apps to be created that have now led to 2-3 billion downloads. However, when they started, the whole discussion and debate around the Google Voice app was very important to me, because as I look at new apps, understanding which ones are going to have freedom to operate within that environment is critical. So when you think about the wireless market from a wireless application perspective, historically the carriers have had a lot of the power in that relationship. When you think about the apps that they put on deck and other things, as you shift to the App Store and other applications where the actual device vendor can help manage that, it becomes important to have freedom to operate within those environments as well. So although it hasn't impacted any of my investments yet, it has impacted the deals that I look at. And so understanding that, any application you look at has the opportunity to operate in these environments is very important.
We are already starting to lose people. We've lost one commissioner and one panelist in the past 60 seconds. So I'm mindful that the big hand and the little hand are just about pointing straight up right now. So if anyone needs to leave now, feel free to. If we could move into the phase, if anyone on the panel wants to ask another panelist a question or respond to something someone else has said, we can move into that phase as well. And I also want to open it up to audience questions, too, before we lose the entire room. So thank you, Mr. Bronner. So first of all, so questions for panelists or follow-up comments as well to and among each other. Going once. Going twice. Everyone has lunch plans. Okay. Yes, sir. No. Okay. From the audience. Press is included. This is open to the press. Okay. Very good. So I think what we'll do is maybe at this point wrap it up in that case, because I sense that the folks are eager to perhaps move on. I have probably 50 different questions, and I can sit here all afternoon and ask you them. But I think we've covered on a lot. Your constructive comments at the beginning were very, very helpful and informative, and the answers to the questions as well. So thank you all very, very much for coming. I want to we'll obviously keep the record open in this proceeding. If folks want to follow up with any letters or clarifications, you get back to the office and you smack your forehead, and I didn't mean to say something that way. That's fine too. So please feel free to file in the record. So thank you all very, very much for coming, and this has been very valuable.